Every month I go through the CREB data so that you don't have to. And this past month data, I have seen the strangest split I have seen yet in this cycle. Two Calgary districts set record high detached prices. The West now sitting above $1 million, while the apartments have dropped below their 300,000 high, and they're down year over year by 9%. Same city, same month. So today I will show you whether you're buying or selling this summer, which part of the market you are in, district by district. So let's start by taking a look at the headline numbers for June. As you can see, total sales came in at 2,197. Now that's down year over year at 3.18% year over year. However, the interesting thing to note here is that June's numbers came up higher than May 2026 levels, which is a month ago, which didn't happen last year. And the benchmark price is at 572,500 this month, which again now is a 5-month streak of prices increasing in benchmark prices. So that's down year over year at 2.07%, but has been consistently increasing every single month. The months of supply came in at 3.09, which is basically flat year over year. And then the days on market came in at 37, which is about 4 more than what it was same time last year. And finally, the year-to-date sales is at 11,092, which is down year over year at about 10.52%. But the story here is that demand has been picking up and the amount of supply is slowly dropping. And we will break this down into segments and districts to clearly understand where that story is forming so that you're well informed going ahead, because the next couple of months are going to be quite a bit different from the story that was happening right before June. So this table right here tells you the entire story in one single table. Let's first start with the sales. As you can see, the sales are up year over year at 0.84%. And it is to be called out that this is the first month in 2026 that detached sales are up year over year. So that is a good positive sign. Semi-detached is actually up by 10.38% year over year. So that is the 4th straight month that it has been in the positive. As far as rural goes, we are looking at minus 3.15 compared to last year. And apartment is down by 20%, the worst performing sector. As far as the months of supply goes, you can see detached is at 2.49, and that is actually now a tighter market than last year. And now the benchmark prices, of course, further confirms this, because semi-detached is the only one that's up now year over year at 0.17%. Detached is actually down by 1.42, not all that much. However, when you look at row, we're at 5.5% down compared to last year, and apartment is down by 8.95%. So this slide clearly highlights out the point that we've called out in the previous market update videos, something that I brought up on my channel way before anyone else even saw it happen or reported early last year. And that is the clear split in the market where detached and semi-detached, as you can see, is performing relatively well compared to row and apartments are going completely the other way. Now to report on what is changing this year. So apart from just having that gap all the way till now, until June, that gap is actually closing, and it's closing unevenly, and the data shows it if you know how to read the numbers. It is foresight into what's to come, so let's check it out. Because June's sales gap versus last year was essentially the smallest of 2026, and apartments are still carrying the entire correction. So if you look right here, first let's look at new listings. This is all the data you would ever need for every property type, and it breaks down and gives you a clear picture of what each segment is doing across the entire market. So looking at new listings here, you can see it's down year over year by 7.67%. So huge pullback in the amount of sellers trying to come to the market. And that is pretty much standard across all property types except semi-detached, which has seen more listings than last year, which is strange, but mostly flat at about 1.6%, but a huge pullback compared to everywhere else. So not as many new listings. And then when we compare that now to the inventory, that's where the real story is forming. So inventory for the first time this year is down 2% compared to last year. And to give you a clear picture of what this means is when we started the year in Jan, inventory was actually up year over year by about 20%. So we had a supply glut when we started the year, and you would have seen my YouTube video called Supply Glut about that. So we had 20% extra inventory compared to Jan last year when we started the year. And that number has steadily been decreasing every single month till June, and now we've inflected to the other side where we have lesser inventory than we did have last year. So supply is significantly slowing down, and that's consistent story across all of these, especially detached. And that is the one that is going to take the biggest change in the market, because having a 4% decline for a segment that is in high demand is definitely going to have an effect on its pricing going up, but also supply scarcity. So when you go over here and you look at the months of supply, you can see pretty much across everywhere. This is what we talked about in the previous slide. Detached is extremely tight at 2.49. But how does that now result based on the sales to new listings ratio? Sales to new listings ratio for detached and semi-detached are creeping up to 60% and more. That is the inflection point that is demand inducing. So when you go between 60 to 65 and start crossing that threshold, that is when you can clearly say that demand is returning back to the market. The absorption rate is high enough to hold these levels in terms of months of supply. Now, of course, the days on market for all of these are higher than last year. So far, the trend that we've observed is buyers are not necessarily rushing in, but the demand is there. They're clearly on the sidelines, they're watching, and when they see something they like, they take it off the market. And with the supply pulling back, that demand is taking the best properties off the market. And then right here, finally, in terms of sales, you can see the detached and semi-detached has higher sales, like we said, over last year versus row and apartments. Apartments doing the worst at minus 20%. So where does each segment stand and where is it headed based on all this data? Looking at detached, we are now sitting at 751,000. Of course, year over year, like we said, it's down 1.42, but month over month, it's been going up consistently for the entire of 2026. Semi-detached now sits at 695. So year over year, this is the only segment that has been doing positive, almost flat, but still above everything else. And month over month, it's gone up now 0.51%. Row is also up month over month at 0.43%. We are seeing demand actually return back to this affordable segment. Now in row townhomes, if your row townhome has high condo fees, or if it's more expensive than I would say 350, that's where you're going to see lower sales. But condos up row, essentially within around the 300,000 mark, are actually starting to perform really well, because those first-time buyers are now entering back, and a lot of buyer pool is also transitioning away from apartments into rows. Now, when you look at apartments is at 299. To give you an idea, Jan last year, apartment benchmark price was sitting at about 326. So in the span of about a year and so, they've already lost 26,000 in their benchmark pricing. Year over year, it's down 8.95%. And every month still continues to keep going down. And I anticipate this is going to keep happening. Like I said, we have about 14,000 apartment rentals going to be constructed in Calgary. So that's going to take a huge hit against this apartment segment. And overall, one of the things I should definitely call out is that the spread between apartments and detached is just getting wider and wider. So right now we're sitting at about $451,000 difference between this segment and this segment. So if you were either in apartments looking to level up into row, the longer you wait, the more expensive it becomes, because not only are you losing money on what you already own, but what you want to get to becomes even more expensive. And the same goes if you're going for row to semi-detached, semi-detached to detached. Their spread is going to be increasing more and more, and that divergence is going to really catch up to you if you wait around too long. And I've had a lot of conversations with apartment owners in Calgary that are very, very reluctant, and they want to believe that the apartment segment will see a bounce back. And that's a huge risk to take, especially if you know you absolutely have to upsize pretty soon. And now if you're a first-time buyer trying to get into the market, you have a very huge advantage that you didn't have before. So if you were left out of the market over the last 2 or 3 years, now the row townhomes, you because they corrected towards the first half of the year together with the apartments, and now they're starting to come back up. However, you're still able to get a lot of great properties in that lower price range that you would have otherwise pay for an apartment. So now you're able to level up and skip this entire first step of an apartment and get into a row townhome as your first property instead, as a first-time buyer at a pretty good price, because it saw the same level of corrections or same time of corrections towards apartments. And I do think that a certain segment, the affordability segment, will do really well. We have seen a significant growth in sales, actually, sub 350 for townhomes. So that demand is going to continue picking up, while that has clearly hit home for a lot of people in terms of that who they want to get into an affordable part of the market, but don't want to settle for an apartment. So to quickly emphasize, the detached and apartment market is just completely different in Calgary right now. It's the same city, but completely two different markets. As you can see, the stats on the left versus the stats on the right are diverging more and more every single month. This is a story that I caught on to even before it happened, and I've just been reporting it. So I've now reduced it down to just one slide. And the reason I want to still call this out is because I do want to mention that a lot of people say that we have huge amount of construction in Calgary. It's very easy to build. However, you do have to realize that the split between the amount of multifamilies or high density residential that we are creating is significantly more than the amount of detached homes we are about to create in the same amount of time. And now, because coming down from record housing starts, because of how the market is performing right now, a lot of builders will, of course, pull back on their supply. And if that's going to be happening at the same time, like has been seen in the stats right here, where sellers are also pulling back on new listings, and if that continues and the demand is persistent, then you're going to have detached hit that inflection point where it starts picking up a lot more than the rest of the market. Now let's go by district, because two districts set records high in June, whereas two others fell as much as 15%. So starting with detached right here, you can see that the West set a record at now 1,025,000. So that is a record high price for that district. And year over year, it's up by 3.72%. And the months of supply is at 1.9. So that's a super tight market. If you're looking to sell in this market, you're going to have a great time. It's going to be pretty easy, but make sure you're still able to get maximum dollar value by good presentation on your property. That still matters. And if you're a buyer, there are going to be a lot of strategies that you can put in. Price is not everything. I'm going to put a video right out on that. So if that's something that interests you and you want to know how to negotiate in a market like 2026, because it's not where the last 3 years you just put an offer in and hope and pray that your offer works out. There are a lot of strategies this year, things that you need to be aware of on how to read the market, because the market is completely splitting up into so many different directions. Now going at city center, you can see we are at benchmark 996,000 for detached. That is the second record for that district. So for across all districts. So those are the two record setting districts, city center and west. They are the highest price that they've ever been, and also sitting at 2.73 months of supply. And if you notice, actually for the benchmark price of detached here for city center, it's just $3,000 away from that $1 million mark. So if that continues, next month we will have $2 million districts in Calgary right here for detached. And on a final note, as you can see here, East actually is the only district that has lesser than a 50% sales to new listings ratio. However, it also should be taken with the caveat that they only had 32 sales. So I would take that data with a grain of salt, but every other district otherwise is performing really well. And then month over month, you can see a bunch of districts have gone up. And then East, I would say, is Northeast is your worst performing right here. So you can see they have now over 4 months of supply, and their year-over-year price has come down by 6.8%, the lowest across all districts. The semi-detached segment by district type, as you can see here, Northwest went up by 3.26% year-over-year, and City Center also went up by 0.19%. The thing to note about City Center, hitting its benchmark price of 971,000 puts it at a record price for that district. And West also went up by 2.52%. Now, the tightest parts in the city, the Northwest, sitting at about 1.97 and city center at about 1.96. And East is at about 3.29 year over year. It's down by 3.83%. However, its sales are also very, very low at just 7. The other interesting thing to note is that Southeast, the year over year price drop is at 4.03%. And if you map this to, apart from Northeast, of course, you see North also is down by 1.41%. And a lot of that, what is being affected in terms of these districts for duplex homes, is the new construction. So the new construction is adding a lot of competition depending on where you are, especially areas such as Mahogany. But now if you center in on communities such as Mackenzie Town, Auburn Bay, of course, they're doing a lot better, but then there are a lot of areas in these districts that are facing heavy competition from builders. Now taking a look at row townhomes. So this segment is our first segment that has seen declines across the board for every single district year over year. As you can see, all of them are in red. The most being Northeast, of course, at 10.88%. And on the low side, you have South at 2.27%. Now, West and South, in terms of months of supply, are still relatively tight. So if you are shopping in these districts, you are still going to face some level of competition. It's mostly the affordable row townhomes in these areas that are going really, really fast and are being balanced off. Now, between these two, even though both of them are very tight markets, you can see West actually still went down by 2.15% month over month. And it takes time sometimes for that demand to now catch back in, where your prices will start rising if you have any bidding competition. So it's possible that this low level months of supply will now reflect in the prices for next month over month. And finally, we have our apartments, our worst performing segment of the market. So you can see negative across the board, same as row, but we also have double digit losses in this segment. So down 14%, 14.59, so almost 15% in Northeast, and East is down by 15.42%. High levels of supply almost everywhere, 7 months of supply in East and 5 months of supply in City Center. Northeast is at 6.29. Month over month, only North and Southeast saw some level of gains. One interesting thing to note about this segment is that City Center holds 912 in inventory, and that is about 44% of all inventory across the entire city. And they stay at very high levels of months of inventory, months of supply, which is 5.15. And all that inventory that I told you is coming onto market as new product, especially the rental supply. So about 14,000 units over this 1 year. Guess where most of it is coming on market? The city center. So there is going to be severe competition for downtown apartments in terms of direct builders, because if you can afford a affordable rental unit as someone living in downtown, why would you purchase a resale unit? This table right here shows the entire picture for the whole market on a single chart. And as you can see here, apartments, obviously, clearly the months of supply, all of them in red. So wherever you see red, that is your buyer's market. Wherever you see green, that's a seller's market, and then everything else in between. And as you can see, apartments, of course, red all the way through, but also Northeast, every single property type is in red. Now, the two that are very, very tight are your West is for detached, you're at 1.9 months of supply. And then for the Northwest, you're at 1.97 for semi-detached. Even City Center is at 1.96. So these are very, very strong competitive markets that you need to position yourself well. Like I said before, I'm going to put out a video. So make sure you follow this channel on how to be putting offers in 2026. It's not the same game that's going to be played over the last 3 years. You really need to know your local data, and there's different specific things you need to pull to have full advantage over the seller, and make sure you watch out for that video coming out soon. Now getting into my favorite part of the market update, which is the 3 key signals that I find every single month for upcoming trends finding data points that connect and make sense and create a new narrative for things that we need to look out to going forward, and tells you where you should position yourself in the market and things you need to watch out for. So first, looking at the macro backdrop, you can see right here the interest rates going into this year. Towards the end of the year, we were expecting a bunch of rate hikes with the high levels of uncertainty if inflation was persistent and kept going, like how we saw with the oil prices. However, now we know that the Bank of Canada is not intending to increase the interest rates till the end of this year. Potentially the first 6 months of 2027, we might see rate hikes. Now that creates some levels of optimism for the buyers. And over the last 2 years, despite all the rate cuts we've seen on a national level, it hasn't done a whole lot. But that is also because the home prices were far above the affordability levels for a lot of people. And to a large extent, when it comes to Vancouver and Toronto, they still are. However, the affordability index sits at about around 40% now for Calgary. And we're already seeing this buyer demand spike back up in the data. So this level of optimism that's come in the market over the last, I would say, 2-3 weeks is possibly starting to show in the data, and we will know that going forward. Now, when we also look at the supply side of things, so that was the demand. But when we look at the supply has been tightening nationally year over year. As you can see, it's constantly gotten lesser and lesser, and that's gotten to a point where we might hit the inflection of where it is now directly proportional to the amount of demand available. And with the prices having come down nationally over 20%, 29% in certain areas, that might bring a certain level of buyer optimism into the market nationally. And with Alberta leading the way for interprovincial migration, that is going to put some positive pressures back into the market. And if you're interested in macro data and things like that, in terms of how the Canadian backdrop affects our local market, and you want to be aware on that side of things, make sure you follow this channel, because I do put out videos like that. So our first key signal that we are noticing on just the Calgary level is that new listings, of course, have fallen 7.67% year over year to 3,899. Now, sellers are opting out. They're not flooding in the same way. Inventory in the same time is now 6,799 versus this time last year was 6,944. So not a whole lot in terms of, not a massive difference, but this is still your first year over year decline this year. The year over year inventory gap has narrowed every single month. So this inflection point didn't just happen. If it did, it's not a data point we would care much about, because it would be something seasonal or just a carryover from last month's pending sales. However, since Jan, we've been at 20% in Jan, and we've consistently kept coming down, and now we are minus 2.0 compared to last year. So that is a clear trend being set from the start of the year. Our sales to new listings ratio has hit a 56, the highest of any month in 2026. So that is also setting a positive trend on the market overall. Signal number 2 is the average price is lying again. I always say this, don't look at the average price. The benchmark is at 572, so that is down 2%. The average is actually up 3.58%. Technically, both are true, but the mix has actually happened up market, which general data does not tell you. Headlines will just not cover, and most channels will not even call out. So sales above $2 million have actually jumped year over year by 63%. So we have 63% more sales in this $2 million range compared to last year. So it's gone from 22 to 36. And sales above $1 million has gone up by 16.52%. Now, apartment share of sales actually fell from 23.25 to 19.25. So what's happening is the cheaper sales are actually vanishing from the average, pushing the entire average up. Sub 250 sales actually grew 10% as repriced condos fill that entry tier. So we are back to affordability in those levels. So condos that are sub 250 are still now starting to see positive amount in terms of the amount of sales happening year over year. So of course, people are going for affordability. And then on the complete opposite end, if you've watched my traffic light video, if you've not, I'm going to put a link up here and in the description. It clearly tells you how this entire cycle is going to play out. And so it's no surprise that the luxury segment is the first one taking off. And then finally, signal number 3 is detached is tightening while the city overall is softening. So detached months of supply has fallen from 2.6 to 2.49. So that's really, really tight. Citywide months of supply has risen. So detached inventory is down by 3.86% year over year. New listings is also down by 6.86% year over year. So supply is getting shorter and shorter, whereas demand is increasing. The detached benchmark has risen every month of 2026. So gains month over month consistently from 724 in Jan. Now we're at 750,000. So even if you just waited this 6 months, you've already been outpriced by 25,000. The West is now hitting, like I said, 1,025,000, and City Center is at 996. So these both have set record highs in June as per Calgary Real Estate Board. So now let's make this practical. Buyers and sellers, both, what do you actually do in this market? Where do you lead? So apartments is at 4.91 months of supply. You have extreme leverage as a buyer. The year over year, it's down by 8.9%, almost 9%. And you have more than 3% in terms of bargaining power. And this is on the low end. You could definitely go for more than this, because city center condos, for example, you have 912 units overall right now, which is 44% of all inventory. So if you are trying to buy an apartment in downtown, you have significant amount of leverage. And key strategies would be not just seeing the property that you want to buy, but also taking a look at properties in that same building or neighborhood buildings, because now what you can do is you can pit them against each other and drive the price down so that you factor in future losses within your today price. That is the key aspect you have to keep in mind when you're in a market that has such strong downward pressures. You can leverage this to create a buffer for your purchase so that you are already putting in all the future losses into the price today, and you don't have to buy still even at today's prices, because your price is what's going to drive down someone else's condo sale. And Northeast, of course, is down in terms of all types of properties, all the way from 6.15% down to 14.59% year over year. So there's a lot of leverage there. Now, one of the key things I do have to call out is condo prices still have found no floor in June, and they show no signs of it. So Northeast is down 2% just month over month. So you absolutely have to buy for a long-term hold if you plan to buy. For the most part, I'm actually telling buyers not to buy this. There are very, very specific situations when it makes sense. As a single person, for example, if you want to be in a very specific community, accessible to office, you want that downtown transit lifestyle, but you want a sense of ownership and you're not really willing to rent, there are very specific cases then that I might recommend you to still buy, but you have to be prepared mentally. You are playing the long game. Yes, you have lower monthly payments, and the other things do play into your advantage instead of, for example, going for a larger property. And that's why I say there's only specific situations when I would advise you to buy an apartment right now. If you're a seller and an investor and you own apartments, get out right now, because unless you're not prepared to hold it for 5 years or more, then you absolutely should not be in this market holding that property type. Now, where do you have no leverage? In terms of West Detached, you are sitting at 1.9 months of supply, so that's also hitting record highs in terms of pricing, and 3.72% year over year. So you are definitely competing there. Northwest and City Center semi-detached is under 2 months, so again record highs, and Northwest sales to new listings ratio is at 81.58%. South and Southeast detached is at 2.15 and 2.16 months of supply, and South and West row townhomes are at 2.3 months of supply. So that's where you're going to have more competition as a buyer. Now, as a seller, pricing reality is very, very important. Your city benchmark is down by 2%, and the typical sale closes about 2% below list. So days on market has now risen to 37 during this peak season. Stale listings signal negotiability. So if your property is on the market for too long, you're going to start getting more and more low bids on your property. It is very, very important in that first 2 weeks you do the right level of marketing. The way you present your property is very, very important to get as many people through the door. Properties that I list and do open houses for, usually what we will do is we will do open houses on that first weekend, 5 hours, both Saturday and Sunday. And then the second weekend, again, we do 5 hours Saturday, Sunday. So you're getting 20 hours of open house within that first week. And that is your peak time, because you can get anywhere between 35 to 55 families within a week to see your property if it is market corrected and you still have those open houses. If you're going to just sit back and wait and expect buyers to get out of their way and come in this market to check out your property, depending on where you are, you might exceed this point where you then have no power, and then the buyers will negotiate you down. In terms of apartments, price to the last 30 days of sold. You do not want to price it to spring comps. The market clears now 9% below, clearly 9% below last June. As far as by segment, detached west, northwest, city center, and south, price market is at 98.56% sales to list price ratio, and you're sitting at about 31 days on market. So that is healthy. Detached northeast, on the other end, price below the last comp. So the last property, do not think that your property can get more than a very clear comparable in your area. The moment you make that mistake and think you can correct your price later if it doesn't sell, you're already behind the curve, because somebody else would have sold in that lower price, and now you're catching a falling knife because now you're trying to get ahead of the next one that's going to come on the market. So that's the game that's being played right now in a lot of these markets that I have a lot of months of supply. In terms of semi-detached, the strongest seller position in the city, scarcity pricing is defensible. And as far as rural properties go, June's 12.89% year-over-year listing pullback has helped prices stay relatively healthy, but more so on the lower range. So when you have an affordable townhome, you're going to do pretty well in this market. Still stage it really well, market it really well, and leverage that price point. If your property is around that 300, 350 mark, then you'll be able to pull in that buyer pool that is that first time buyer trying to get into this market. And where you still have leverage as a seller, West Detached is recording high prices, of course, so you have leverage there. And then the city center detached, Northwest semi-detached is at 1.97 months of supply, so 81.58 months, 81.58% in terms of sales to new listings ratio. South detached and row, the volume is where it's at, so 2.15 and 2.32, you have good leverage there as a seller. Finally, here's what we want to watch out going forward, things to look out for while you're in the market, but also things to prove the predictions that we have in this report. So if city center detached gains another 0.32%, then Calgary actually gets a second $1 million benchmark price detached district, which will be pretty cool. Inventory lands below July. So if the inventory, like we saw this month, go down, so then we'd get a second straight year-over-year decline. So clearly a supply withdrawal is a trend and not a blip. Now we already know it's a trend because it's been declining since the start of the year in terms of the inventory. But what's curious to see is if it continues to decline, and I expect it will, but whether it is year over year is to be seen. Sales has beat last July of 2096. So 2096 sales last July. If you're able to surpass that, then you would have your first year over year sales gain of 2026. And then you can expect the headline starts coming out and saying the bottom is in. Of course, that would just be one data point, but it's easy to catch on to something like that and make it a big headline. And then finally, if apartment sales holds above 400 with months of supply under 5, then potentially condo absorption is starting, but I really don't think this is going to happen. In terms of row, if it posts a second straight month of month-over-month price gain, then your row floor has essentially started forming after June's 0.28%. And then finally in Northeast, detached listings keep flowing. So if that keeps happening, then Northeast is going to break below the 8% year over year. And the one detached weak spot is going to get even deeper and harder for those sellers to sell and play in the advantage of buyers going forward. And there you have it. That's your July 2026 market report. 2 districts in detached setting record prices while apartments come down below 300,000. Headlines say the market's balanced overall, but now you've seen through the data and you know how different each segment is. The demand is stabilizing, sellers are withdrawing, and the correction has narrowed down to very specific districts such as Northeast and the high density property types. If you found this kind of video helpful, make sure you subscribe. It really helps me reach a lot more people like you so that I can help people in this market be empowered and make the right decisions. And if you'd like to reach out and talk about your specific situation, my QR code's of course on the screen. Plus I offer free guides for buyers, sellers, and the community guide where a lot of people rave about it. Check out the different neighborhoods, the vibe, and pick the right neighborhood for you and your family so that you do not have any regrets down the road. And thanks for all of you that stayed till the end, and I'll see you all in the next video. Till then, take care.